Friends, gather round. Today, we're diving into a topic that's been on everyone's mind lately. It's a word that can send shivers down the spine of even the most seasoned financial experts. Let's talk about a word that strikes fear in the hearts of many: recession. This term often brings to mind images of economic turmoil, job losses, and financial instability. Some economists are saying it could hit us as early as this year, 2025. They're analyzing various indicators and trends that suggest we might be heading towards a downturn. They point to some worrying signs in the economy. These include fluctuating stock markets, rising inflation rates, and a slowdown in consumer spending. But don't panic just yet. While these signs are concerning, it's important to stay calm and informed. We're going to break down what's happening, what it could mean for you, and most importantly, what you can do about it. Knowledge is power, and understanding the situation can help you make better decisions. Think of this as a financial fire drill. Just like in a real fire drill, preparation is key. Knowing what steps to take can make all the difference. It might be a false alarm, but it's always better to be prepared. So let's dive in. We'll explore the potential impacts of a recession and how you can safeguard your finances. We're not saying the sky is falling. In fact, many experts believe that with the right measures we can weather the storm. But we are saying there are some storm clouds brewing. These clouds represent potential challenges that we need to be aware of, and those clouds have names like yield curve inversion and declining consumer confidence. These terms might sound complex, but we'll break them down for you. Don't worry, we'll explain what those mean later. For now, just know that these are indicators that economists use to predict economic trends. The bottom line is this: it's time to get our financial houses in order, just in case. By taking proactive steps now, we can better prepare for whatever the future holds. Right now, the US economy is a bit like a teenager's bedroom: messy, confusing, and full of surprises. On the one hand, we've got some good things going for us. Consumer spending is still strong. People are buying stuff, which is good for businesses. The labor market is also holding up pretty well. Unemployment is relatively low, meaning most people who want jobs have them. But there are also some worrying signs. Remember those recession indicators we mentioned? Yeah, they're starting to flash red. The economy isn't growing as fast as it used to, and some experts are worried that things could slow down even more. It's like driving a car with the gas pedal and the brake pedal both halfway down. You're moving forward, but not very quickly, and at any moment you might have to slam on the brakes. Let's talk about those flashing red lights, shall we? The signs that tell us a recession might be on the horizon. These indicators are like the canaries in the coal mine, giving us a heads up before things get really tough. One of the most reliable indicators of a coming recession is something called the yield curve inversion. This might sound like financial jargon, but it's actually quite telling. It's a bit complicated, but basically, it means that interest rates on short-term loans are higher than interest rates on long-term loans. Imagine going to a bank and finding out that borrowing money for 2 years is more expensive than borrowing it for 10 years. Strange, right? It's like the bank is saying, we're more worried about you paying us back in 2 years than we are in 10 years. This unusual situation often signals that the economy is about to take a downturn. And historically, when that happens, a recession often follows. It's a pattern that has repeated itself time and again, making it a crucial indicator to watch. Another red flag is declining consumer confidence. When people start feeling uneasy about the economy, their spending habits change dramatically. When people feel good about the economy, they spend money. They go out, shop, dine, and invest in big-ticket items like cars and homes. But when they're worried about losing their jobs or their savings, they tighten their belts. They cut back on non-essential spending, which in turn affects businesses and the overall economy. And right now, consumer confidence is dropping. People are nervous. They're reading headlines about economic instability and reacting by saving more and spending less. Add to that a slowdown in corporate profits and a shaky stock market, and you've got a recipe for economic indigestion. Companies are earning less, stock prices are volatile, and the overall mood is one of caution. All these factors combined paint a picture of an economy that's on edge, teetering on the brink of a recession. Now let's talk about the elephant in the room, Donald Trump. His trade policies, like those tariffs on goods from China and Canada, have created a lot of uncertainty in the global economy. Businesses don't like uncertainty. It makes it hard to plan for the future. And when businesses are uncertain, they tend to hold back on hiring and investing. That can slow down economic growth. Trump's moves on the economy are unprecedented for a U.S. economy. As a result, this could throw the economy for a little loop, but nothing says that it will not bear its fruits. Look, we're not here to debate politics, but it's impossible to talk about the economy without mentioning the impact of Trump's policies. Section 5. Expert opinions, a range of views. So, what do the experts think? Well, as usual, they don't all agree. Some economists, like Stephen Blitz from T.S. Lombard, believe that the economy is still fundamentally strong. They argue that the current slowdown is temporary, and that growth will pick up again soon. Others, like J.P. Morgan, U.S. Market Intelligence, are more pessimistic. They're worried about the trade war, declining consumer confidence, and the potential for a global economic slowdown. They believe that a recession is a real possibility. Who's right? It's hard to say for sure. The economy is a complex beast, and even the experts don't have all the answers. But one thing is clear, there's a lot of uncertainty out there. Section 6. Preparing for the storm, financial steps. Whether or not a recession hits, it's always a good idea to be financially prepared. Financial stability is not just about surviving tough times, but also about thriving in good times. Think of it like wearing a raincoat. You might not need it every day, but when the storm comes, you'll be grateful you have it. It might not rain, but if it does, you'll be glad you have it. Just like a raincoat protects you from getting wet, financial preparedness shields you from economic uncertainties. So, what can you do to get your financial house in order? It's about creating a solid foundation that can withstand any financial storm. Here are a few tips. These steps will help you build a robust financial plan that can weather any storm. 1. Build an emergency fund. This is your financial safety net. Aim to have at least 3 to 6 months worth of living expenses saved up in a readily accessible account. This fund will be your first line of defense against unexpected expenses. This will help you weather any unexpected financial storms like a job loss or a medical emergency. 2. Reduce your debt. High levels of debt can be a significant burden. High levels of debt can make it difficult to stay afloat financially, especially during a recession. By reducing your debt, you free up more of your income for savings and investments. Focus on paying down high-interest debt like credit cards as quickly as possible. This will not only save you money on interest, but also improve your financial flexibility. 3. Diversify your investments. Don't put all your eggs in one basket. Diversification is key to managing risk. Spread your investments across a variety of asset classes like stocks, bonds, and real estate. This way, if one investment performs poorly, others may perform well, balancing out your overall risk. This will help reduce your risk if one particular asset class takes a hit. By following these steps, you can build a financial plan that not only prepares you for the worst, but also positions you to take advantage of opportunities when they arise. Financial preparedness is about being proactive, not reactive. Section 7. Weathering the downturn, career and lifestyle. Preparing for a potential recession isn't just about your finances, it's also about your career and your lifestyle. 1. Make yourself indispensable at work. During tough economic times, companies are more likely to lay off employees who aren't essential. Make sure you're adding value to your company and that your skills are up to date. 2. Consider developing additional income streams. Having multiple sources of income can provide a financial safety net if you lose your job or your primary income stream is reduced. Explore freelance work, side hustles, or passive income opportunities. 3. Live below your means. If you're already living paycheck to paycheck, a recession could be devastating. Start tracking your spending, identify areas where you can cut back, and make a conscious effort to save more money each month. Section 8. The importance of proactive measures. The key takeaway here is that you don't have to be a financial expert to take steps to protect yourself from a potential recession. Even small changes like building a small emergency fund or paying down a credit card can make a big difference in the long run. It's easy to feel powerless when you hear about the possibility of a recession, but the truth is, there are things you can do to prepare and to mitigate your risk. Think of it this way: you wouldn't wait until it started raining to buy an umbrella, would you? Of course not. You'd buy it beforehand so you'd be prepared. The same logic applies to your finances. Section 9. A balanced outlook, risks and resilience. So, there you have it. The US economy is facing some challenges, and a recession is a real possibility, but it's not a foregone conclusion. The economy is resilient, and it's possible that we'll avoid a full-blown downturn. The most important thing is to stay informed, be prepared, and don't panic. By taking proactive steps to manage your finances, your career, and your lifestyle, you can weather any economic storm that comes your way. And hey, if all else fails, you can always stock up on ramen noodles and binge-watch Netflix. It's what got us through the last recession, right? Gasp, 1S. Get your copy of Entrepreneurial Inspiration by A-List Mindset on Amazon.com to keep yourself no matter what the economy is throwing at you.